Mortgage spreads just hit 2%. That's the best they've been all year. And that's the only reason that rates aren't near 8% right now. Meanwhile, Wake and Brunswick counties are both putting up their strongest permit numbers in almost 2 years. Strange. National sentiment is souring. The local tends to be a little bit different. So let's get into it. For the first part, we're going to talk about rates and the spread story. So 30-year fixed is sitting at 6.83%, 10-year Treasury yield at 4.74%, both at yearly highs as the Iran conflict escalates and the Fed stays hawkish. We all saw the meeting last week. Definitely something to keep an eye on for the rest of this year. Now, I've had this question a few times, thought it'd be good to hit here. What a mortgage spread is. It's the gap between the 30-year mortgage rate and the 10-year Treasury yield. Mortgages are riskier and less liquid than Treasury, so they always trade above the 10-year, historically by about 1.6 to 1.8 points. When the spread is wide, mortgage rates are higher than the bond market alone would justify. When it narrows, that's free rate relief with no Fed action required, which is a good thing because they are not doing anything right now. So this week's spread is 2%. It's up slightly from the 1.94% from the week before, still within that range of 1.6 to 1.8%. And really far better than 2023 and 2025. So let's go through the math on that real quick so you can just see how impactful this is. So when we look at a 10-year yield, if we had 2023 era spread levels, mortgage rates would be 7.98% right now, not 6.83. If you did the 2024 era spreads, 7.6. At 2025 era spreads, 7.4. That's over a full point of relief this year alone, just from spreads normalizing. That has nothing to do with the Fed at all. Next, let's go look at some demand signals, actual numbers in the market right now. Everybody knows I like to look at purchase apps on a weekly basis. The MBA's index, it's a good 30 to 90 day lead indicator on closed sales. Right now, the index is sitting at 159.8 as of the July 29th release, down from 165.8 the week prior. So that's about a 4% week over week figure difference there. For context, for most of 2026, it has run roughly between 150 and 180. So again, it's a mid-range, not a breakdown. We're cooling off of a strong run, not falling off of a cliff. I've been seeing all of this stuff circulating about falling off a cliff. It's deceleration, not falling off a cliff. So year over year, purchase applications are up only 3% now. So that's a sharp step down from earlier in the year. Overall, the picture of it is basically that it's a positive year. I just think we're going to see not as strong finish to the year. So if we're break even by year end on this, that will be a good number for us to be at on a national level. Weekly pending sales, 69,109 sales this year versus 68,413 last year. Still positive year over year. For late July, early August, this is typically a seasonally softer stretch as the spring and summer rush fades. Again, deceleration is the term of the day. We're slowing, not by a lot, and that more matches the normal seasonal pattern that I track. It's not really a red flag on its own. Total pending sales rolling 396,572 versus 386,561. Again, still growing. It's just a strange market because I do anticipate that coming back down as the year goes on. New listings 72,556 this year versus 69,836 last year. Now remember, this is resale and new construction listings combined in the Altos data set, not new construction alone. So it's healthier than 2023 levels, but we typically see that range on a national level between 80,000 and 100,000 in a peak season. In reality, we've only cracked 80,000 4 times all year and never in back-to-back weeks. Now, another one that we like to keep an eye on is inventory. Inventory rose from 865,233 to 872,932 this week. That's 7,700 additional units. Same week last year rose from 860 to 865. That was an additional 5,000 units. Inventory is building faster than a year ago. Year over year growth right now is running at a positive number of 0.85%. Something to keep an eye on as we're seeing that inventory climb. And I'll talk about this a little bit more here in a minute. It's very regional and it's very localized. It is really wild to look at. If you drill down into the data, look at your own data sets in your local market, even within the zip codes of your own counties, cities, you will see differentiators here. It's an interesting time on how macro and micro are interacting. Price cuts 40.97% of listings this year versus 42% last year. This matters because about 1/3 of homes typically see a price cut before selling in the normal market. So we're still running, again, above that baseline, even though we're below last year's share. Builder incentives, rate buy downs, closing cost credits, they are not captured in this number. That's a separate lever that the builders are pulling. So I think this number likely understates how much of a real concession is happening, especially on the new construction side. Now, let's jump into the next part, consumer confidence versus reality. I love tracking these numbers. It gives you a really good insight into the buyer's mentality in the market. So right now, the consumer confidence fell to 90.8 in July, missing the 92.4 forecast. Context for what is a good number: indexes scaled to 100 back in 1985. Generally, readings above 100 signals confident consumers, while sustained readings in the 80s to 90s have historically coincided with economic softness. So 90.8 is soft, not crisis level. Now, there's other indexes I like to look at too, just to give me a barometer of where everything's at. Present Situation Index, it's half of the Consumer Confidence Index. It measures how people rate current business and job conditions right now, and that's different from the Expectations Index, which measures their 6-month outlook. So Present Situation fell 3.6 points to 114.9. It's the third straight monthly decline, lowest since February 2021. The Expectations Index fell flat, 74.7, still below the 80 mark that's historically been associated with the recession risk. Overall, my takeaway from those numbers and your headline: national mood is worse than national housing data right now. Confidence usually leads behavior with a lag. That's worth watching whether this shows up in purchase applications in the coming weeks. My guess is it is going to show up and show up in a big way. I just don't know exactly when it's going to be, but I think it's going to coincide with seasonality, and that could present a lot of headwinds for the real estate market in the coming weeks. Now, let's jump into market news: Fed tariffs, some builder earnings. The Fed held its rate. We all saw the meeting last week, steady at target range 3.5 to 3.75%. That's the 5th straight pause. But, and this is one thing that really perked my radar up, 3 regional Fed bank presidents pushed for a 1/4 point hike instead. That's a very hawkish split. Next decision is September 15th. The Fed chair, Kevin Walsh, speaks at Jackson Hole in August 27th. That speech is likely to move rate expectations more than any other data release that we have between now and then. Maybe the inflation data will come out and that'll spark some conversations. Who knows? Next big thing was tariffs. The Supreme Court blocked the administration's ability to impose tariffs without congressional approval earlier this year. The White House has been rolling out new tariffs under a slightly different legal justification. At the end of the day, expect a 10% to 12% tariff tied to labor practice enforcement to stick, and it's expected to hold up legally this time. It's relevant for builders and our real estate market because it touches imported materials. So that means that things will rise in cost again. Expect to see some of that come down the pipeline. We talk about this in deepdirt.co. If you're not a member, get in there. On our land desk report, we look at aggregators and different building suppliers up and down the supply chain so we can see what's coming down the pipeline, and it's eventually going to fold into the real estate market. Builder earnings, NVR, Orion Homes, they're kind of more luxury exposed than most public builders. They reported earning per share, or EPS, down 23% year over year and revenue down 16%, but new orders actually increased. Again, which lines up with what we're seeing in the local permit data. Builders are managing margin, not volume. Keep an eye on that. We're going to keep an eye on D.R. Horton, Lennar, and Pulte Group's next earnings for a broader read against price points. Jobs, the July jobs reports drops on Friday, August 7th. June came in soft, so only 57,000 jobs added. Well below expectations, though. Unemployment dipped to 4.2% as labor force participation fell. This Friday's number is the next real test of the soft landing versus real slowdown question. And again, you combine that, it's going to land right on top of a hawkish Fed, elevated rates. It could make some rate cut odds shift in the favor of seeing no rate cuts for the rest of this year, just depending on how bad the data comes out. Last part, local reality check here. I always like to take the national and then dial it back. The market I operate in is really North Carolina as a whole. And my primary market is, of course, in the triangle, kind of middle part of the state. So right now I put all the building permits, and it's been fascinating to watch this data roll through. It's a little bit of a messy thing to pull, just because it's Census Bureau data and it's really big and complex. And then they tranche it down and they have it all broken out in different zip codes and area codes and FIPS codes. So to consolidate it is challenging. But the reason I like the permit, it's the local government's authorization to start construction issued before the ground is broken. It's a true leading indicator. Permits run ahead of housing starts by weeks, and they're ahead of completed move-in ready homes by anywhere from 6 to 12 months, depending on how fast the builder builds a house and how fast they can sell it. So when the permits are moving, it's builders telling you what they expect demand to look like a year from now, not what it looks like today. So it's a really excellent indicator of where we're skating towards in the next 6 to 12 months. Nationally, single family permits have been range bound kind of between that 600,000 to 700,000 at the top end for most of 2026, with builders leaning on rate buy downs to keep volume moving rather than pushing their new supply. Complete flip from 2020 and 2021 when they were pulling inventory forward. They couldn't get lots fast enough. State level, North Carolina permit activity, they really mirror the national plateau. Steady, not surging, consistent with the builder base, managing margin over growth. That's going to be a headline that you should all pay attention to. Margin over growth right now. So Wake County, last 3 months, highest monthly single permit family prints in almost 2 years. Really shocked me a little bit. It's a reacceleration, not a fade. I expect it. It's still 23% below the 2022 cycle peak on a trailing 12-month basis. So it's recovery off of a lower base. It's not a new boom. I was just shocked to see the numbers accelerating in that area. But again, like I said, it's a local game when it comes to real estate, and everywhere is slightly different. Raleigh is that growth market. And I pulled 2 other counties. I looked at Johnson County, kind of a sister county that we operate in. It's already crested back in mid-2021. It's flat to declining, running 30% below that peak. It's plateaued right now, not really cresting, which again, if you listen to the news and the rhetoric out there, you would think they are just slinging permits every day. It's actually pulled back quite a bit, and I'm guessing that's some of the interest rate impacts and affordability issues that we're seeing. Brunswick County, our largest permitted county in the state, still climbing. June was the strongest single month in the data set, new 12-month high. Haven't seen it crest yet, so that's something to keep an eye on. There will be a tipping point when that becomes a little bit too saturated, but it's also strange because it's one of those counties where you have a lot of inbound buyer growth coming back either from retirees moving back from Florida or from other states, or you have service-based individuals moving there to serve those new buyers from the baby boomer segment. So it's an interesting county. It's kind of chopped in half when you look at it. We also have military installations there, so you have a lot of military home buyers. All of that could shift at a moment's notice. We'll keep an eye on it as it goes forward. So again, just from the news cycle and the loudness of the NIMBY crowd, I thought Brunswick and Johnson were both cresting and Wake was fading. Data was opposite on 2 of those 3. So again, if feelings are one thing, guys, always check the data. And that's why we pull the numbers all the time. So at the end of the day, what does this mean for everybody? For agents, if your rates are above 6.4% or 6.6% and they're now starting to test 7, remember that means softer buyer demand within a few weeks. I would flag this to your rate sensitive buyers now. Wake's permit reacceleration means more new construction is coming. 6 to 12 months, get ahead of that. What I would love to see is how much of that is considered new permit in terms of like renovations or teardowns, and they're already sold units versus actual new spec inventory coming to the market. For investors, Brunswick County is still the builder's playground right now. I would be careful in that area. Underwrite your deals very, very conservatively. Same with Johnson County. Really most of the middle part of the state eastward. I would look at steady absorption, not growth in all of those counties. If you're a buyer watching this and you're just trying to figure out which story is the one to watch, I would say you're looking at if the spreads keep compressing the historical 1.6 to 1.8 range, that's real payment relief independent of anything the Fed does. So talk with your lender, talk with your agents, make sure that you're watching that current spread versus the rate when you're shopping. And then for sellers, price cuts are still running near 41% of listings. It's still running high. We're seeing it tick back down, but if you overprice in this market, you're going to get punished, and punished in a way that is not immediately identifiable. It will come from you sitting on the market with no showings and no offers far longer than everyone else, and then you're going to start chasing the price down, and it's a battle you don't want to get into. So price it right from the beginning. Make sure you're taking into consideration all of these different macro factors that are happening in the market. Bottom line, national sentiment is cooling. The Fed split and the rates are testing 7% again. But the triangle and the coast, just in our own state, they're not cooling evenly. We're seeing some of these areas pop in terms of building permits. Some of these areas are not popping at all. So make sure you're following along. Subscribe to the channel if you haven't already. Go join deepdirt.co. We send out a weekly newsletter, Dirt Almanac, that looks at all of this data. And then we go deep dives into all the things that could impact the real estate industry. So if you want to be ahead of the curve and not behind it, come join us. Look forward to talking with y'all next week.